now the Fed has now they have an excuse to go out there. Essentially, everyone's handed the Fed and the federal government a blank check to try and monetize their way out of this. And I don't know if they'll be able to do it this time without destroying the dollar.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and certainly fascinating financial times in the markets. Fortunately, Dave Kranzler is warming up, getting ready to join me for his regular weekly appearance, where he'll be digging into some of the actions of the Fed and all the other fascinating, stunning things that have been going on. Quick note before we get started, if you would like to help support the show, there's a button appearing in the upper right where you can do so. Certainly, we always appreciate your support here at Arcadia. Allows us to keep the show going and add some other fun things we have planned for this year. So if you are able and interested in supporting the show, click that arrow. And with that said, here is today's episode. Dave Kranzler, a pleasure as always to welcome you to the show, especially this week where maybe it's safe to say the bubble finally popped. It's fascinating. Things have happened so quickly. It's as if we've had 2007 and 2008 pushed into 1 month. So I think people are still letting things digest. Anyway, with that said, it's great to have you here. Folks, before we get started, hit that subscribe button and the notification bell. And that way you can stay posted because, Dave, I'm assuming you have all of the answers for us today, correct?
I don't have any answers anymore.
Well, hopefully you're going to be able to tell me and some of the viewers how we can access the Fed's discount window, because apparently in the span of a week, the Fed... Well, maybe I'll just stop and let you take it from here because I'm so flummoxed. I mean, I think this was a historic week, and we finally got that Sunday night announcement that so many people have been waiting for. I don't know if they thought that was the one, but anyway, take it from there. What are you seeing with what we've seen in the last week?
Do you think you'd be able to spell flummoxed on your first try?
Well, I've got a better chance than Ben Bernanke understanding the gold market, I will say, which I got a shot.
What am I seeing? I mean, I wrote about this a few months ago when the repo operations were initiated and then started getting bigger and bigger. I said there's a giant call on the credit markets going on right now, a giant margin call, and the Fed has no idea how big it is. The banks themselves don't know how big it is. I mean, there's a whole world of shadow banking out there that's for as opaque as bank operations and what the Federal Reserve does is, the shadow banking market's even more opaque. And essentially, the global financial system and the U.S. financial system has been one giant Ponzi scheme for the last 10 years. And when something comes along that pricks the equity bubble that kind of is underneath it all, kind of supporting it, the rest of the stuff shrivels. And that's essentially what we're seeing. So, and the shriveling has to do with, and this was happening way before anyone ever even heard of coronavirus, was the general meltdown in subprime risk assets.
Yep.
And now the Fed they have an excuse to go out there. Essentially, everyone's handed the Fed and the federal government a blank check to try and monetize their way out of this. And I don't know if they'll be able to do it this time without destroying the dollar.
Yeah, it's a good point you mentioned there, Dave, because if I had to pick one takeaway from the last week, not easy to do yet. What was really stunning to me was seeing Fed throws $1.5 trillion in there Thursday. Then by Friday, they said we had planned to buy this amount of treasury bonds over the next month or couple of months. And they said, we're doing half today. And then by Sunday, you get quantitative easing. It feels almost as if we're at that point where it's like, let's throw a trillion today. Hey, if that doesn't work, we'll throw in 2 trillion tomorrow. Yet on some of these moves, especially Monday, the Fed does QE, and it's like the market just laughs at it. I mean, it has the. Do you think the Fed lost control in the last week? In that, perhaps the most startling part is that there hasn't been much of a reaction to unprecedented amounts of money.
Well, I would back up. I would say that in mid-September, when the Fed started getting involved in the repo market, I think that was the indication that the Fed had lost control. And not just the Fed. I mean, it's all the central banks globally.
Yeah, and I mean, and yes, although still over those past couple months, obviously we've talked about Tesla plenty, and you saw a lot of these tech stocks, and the bubbles just kept getting bigger. But I mean, even if you go back to March of 2009, when the Fed really did the second part of QE1, but whatever you call what they did in March of 2009, that started this recovery where Fed's printing money, doing QE, stocks took off. Whereas it's just startling that they've done the same thing, yet the stock market, it's almost as if their move isn't working anymore. I mean, maybe it never worked, but now even the stock market is not responding to it.
I mean, I think if they print enough money, eventually the stock market will respond. I don't really. There's no way to know the size and the scale of the problem. And I mean, back then, the amount of financialization and risk assets that had been created prior to 2008 were it was smaller than it has been over the last 10 years. I just got done listening to a podcast, some guy, and a lot of what he had to say made a lot of sense, but then he lost me when he started to say that, you know, this is different from 2008 because of all, the new regulations put into place, gave the banks stronger balance sheets and less leverage. And nothing could be further from the truth. The legislation made it easier for the banks to move the risk profile of what they were doing off balance sheet. And the derivatives problem is at least as big as it was last time. The subprime credit problem is way bigger. I mean, back then the majority of it was the subprime mortgages. This time around, we've got, well, I would argue that the 3% down payment Fannie and Freddie mortgages, most of those would have been considered subprime 10 or 15 years ago. That would have been the way they would have been rated. The 3% down, 60% DTI, and the 3% down doesn't even have to be cash from the buyer's pocket. It can be a loan from friends or whatever. So you still have the subprime mortgage issue out there. You've got, now on top of that, you've got all of the auto loans out there, credit card loans, personal loans. I mean, if you look at subprime auto loans plus subprime credit card loans, it's a bigger problem than the subprime mortgage problem was that led to the 2008 financial crisis. So, and then there's also a lot of this stuff we don't even know what's going on because you got private pools of capital that have been doing the equivalent of the type of subprime mortgages that were being done, maybe not quite as egregious as they were in the the early 2000s housing bubble. But some of these hedge funds that have excess cash have put out these facilities where they're lending, where they do private loans, 100% financing, bankruptcies okay, that type of thing. And there's no telling how large that is. I mean, it's not as large as what Fannie and Freddie have been doing, but it's still going to be a significant factor. But at any rate, my point here is this guy was sitting here pitching the argument that the banking system was in better shape, on a stronger foundation this time around than it was last time. And I would argue that it's in way worse shape than it was last time. And regulators have been much more willing to look the other way in the last 10 years than they were in the previous 10 years leading up to 2008.
Yeah, and I'd agree with you there because we had this crisis in 2008. Yeah, there were some cosmetic regulatory changes, none of them really of a free market variety. Yet you piled on the debt, not you, Dave. Sorry, the government piled on the debt. Fed has gone nuts, expanding their balance sheet in the past decade. And you mentioned that it really comes down to, is the Fed going to try and print everything? Well, it looks like that's begun. Here, I saw this one yesterday, which was pretty alarming. Treasury Department asked Congress to let it backstop money markets. Certainly not a good sign. Then we had Fed to launch commercial paper funding facility. So now they're buying corporate debt. Fed to relaunch primary dealer credit facility. And like you pointed, and that's not even to mention that Trump wants to do I thought it was interesting when it came out the other morning, it was 850 billion. By the end of the day, they had rounded it up to a trillion. And maybe you can also tell us what you're going to use your $1,000 check on. I think that would be fun to know.
I'm not clear who's going to be getting the checks.
I mean, regardless of one's view on what Corona is or isn't, or who started it or where it came from, it seems pretty clear that one way or another, whether the White House or the Fed, a blank check has been issued. And perhaps what's even more alarming is that we don't know what they'll do tomorrow. All this stuff is already blown away 2007, 2008, and it seems like the Fed has no plan to stop anytime soon, does it?
Yeah, I mean, the problem is they don't know, there's no way to know what the scope of the problem is. I mean, and again, I'll refer back to the start of the repo operations in mid-September. They knew there was a problem back then, and remember, back then it was just supposed to be a temporary liquidity thing, a small repo operation, short term, help corporations pay their quarter end taxes and some other, clear out the plumbing of the repo markets. I hate that analogy. The plumbing, the financial plumbing. It's like the least dirty shirt analogy. I hate that. No, I don't put on a dirty shirt. If my shirt's dirty, I take it to the cleaners and get it cleaned. But at any rate, all of a sudden we went from a short-term, small, temporary repo operation to it just grew in size and duration. And I think before the stock market tipped over, I think they had extended it all the way out to June or something like that. So, I mean, they've increased the size of the repo program, and on top of that, in response to this, the damage caused by the crisis, they've piled on so many other programs. I'm going to have to sit down and sort of put it down on paper exactly what they've announced and how much they've thrown at this so far. And I may be wrong about this, but I'm pretty certain they're going to have to throw multiples at this versus what they've thrown at it so far in order to keep the system from collapsing.
Well, unfortunately, I wouldn't doubt that. It does seem like it's headed that way. Although, as always, I appreciate what you do with your site, Investment Research Dynamics, where you've been covering these things. You give people information for free. Also have the Short Sellers Journal and the Mining Stock Journal. So people do want some more help figuring out what's going on. You do offer those, and I thank you for that, sir. And
did you read my Mining Stock Journal that went out a day early yet?
I did see you got it out on Wednesday. I didn't get to it yet. I still got it.
Oh, I've had a great response to it so far.
What's that?
I've had a great response to it so far.
Well, I would certainly imagine that. And folks, if you were interested in checking out, Dave, do you still give the first month free offer for the journal?
First month free? I've never done that. It's already cheap as it is compared to what else is out there.
Well, I thought you had a guarantee where if they read the first month and they're not thrilled,
you don't. There's no minimum subscription period beyond the first month. A lot of newsletters require, 3-month or 6-month minimum subscription duration. You can sign up for the first month, and if you don't like it, cancel it, or email me and I'll cancel it.
Well, I appreciate that. I don't think many people will be canceling it. Folks, as you heard for the last 20 minutes, Dave's got a great body of knowledge and experience he shares. So you have my
I'm full of a lot of hot air.
Well, maybe a little bit of that too, but I guess that's the result of spending a couple of years on the East Coast. Sorry, East Coasters. But anyway, with that said, Dave, I thank you for joining me. And folks, if you're trying to still get a handle on what's going on, stay tuned. Another video coming your way, and we'll bring you Dave again next week.